Welcome to Rich Tribe. Look, let's just get real for a second. Most people honestly spend way more time planning their weekend plans or their next summer vacation than they do actually planning their financial freedom. And we're going to change that today. Because if you want to stop trading your precious time for money and actually start building generational wealth, you need a bulletproof system. So today, you're getting a millionaire's blueprint. We're going to break down the exact mathematical steps to take you from barely surviving to absolute financial stability.
Okay, Marcus, wait a second. That sounds amazing in theory, but let's be super practical here. How can the average person even begin to wrap their head around building generational wealth when just surviving costs so much right now? I mean, between inflation, rent going up, daily groceries, it just feels completely overwhelming to even get to the end of the month, let alone get rich. You hit the nail on the head, Rachel, and that is exactly why most people stay trapped. But wealth isn't about getting lucky, it's about systems. So let's jump right into step one. Audit your needs and master your budget. You've got to start by literally printing out your last 3 months of bank statements. Go through them and highlight every single want in red. It's eye-opening. To actually fix the leaks, wealthy people use frameworks like the 50-30-20 rule. It's simple. 50% of your income goes to absolute needs, 30% to wants, and 20% is ruthlessly protected for your wealth goals. But Marcus, hold on. How do I maintain this perfect 50-30-20 balance when family members are constantly calling with financial emergencies? That's a huge issue for so many of us. Those family demands just completely drain that 20% savings goal instantly.
That is absolutely crucial to bring up, Rachel. What you're talking about is commonly known as the black tax. Look, helping your family is a beautiful, noble thing, but responding to every random urgent request is gonna destroy your budget. So the millionaire fix for this? You build a system for it. You set a black tax cap. You basically open a totally dedicated account and allocate a fixed automated amount to it every single month. When family asks for money, you can just say, hey, I have a standing order for this exact amount on the 25th. It manages their expectations, but way more importantly, it protects your own financial foundation. And protecting that foundation brings us right to step 2, build an unbreakable buffer. Because let's face it, living below your means shatters the exact moment you face a sudden emergency. I totally hear you on the buffer, but for someone living paycheck to paycheck, being told to save thousands of dollars for an emergency fund is, well, it's incredibly discouraging. Where do you even start when the target feels that massive?
You start small, Rachel. Like really small. Behavioral data and tons of research on saving habits actually show us that the biggest hurdle isn't hitting that final goal. It's simply making that very first deposit. People literally get paralyzed by the final number. Don't even worry about thousands today. Just worry about putting away your first $20. Getting the engine started completely changes your financial psychology.
So, here are the exact steps to build that safety net. First, assess what 3 to 6 months of your bare bones essential expenses actually looks like. Second, open a separate high-yield account. And I mean separate. It must be at a different bank so you aren't tempted to dip into it for everyday spending. Third, automate those small, consistent contributions. Automation is quite literally the secret sauce of the wealthy. It removes human error, it completely removes the need for daily willpower, and it absolutely guarantees that you pay your future self first. All right, once that buffer is growing, we go on the attack with step 3, annihilate debt strategically. Yeah, high-interest debt definitely feels like a parasite just eating away at your money. What's the absolute best strategy to destroy it when you feel like you're drowning in payments?
Well, there are 2 main strategies, and you really have to pick the one that fits your own psychology. First is the avalanche method. Now, this is the mathematically superior way. You make minimum payments on everything, but you throw every single extra dollar at the debt with the highest interest rate. It saves you the most money over time, period. But if you're the kind of person who needs quick wins to stay motivated, you want to use the snowball method. With this one, you attack the smallest balance first, totally ignoring the interest rate. Once that little debt is paid off, you roll that payment into the next smallest one. It builds incredible psychological momentum.
Up until now, we've basically been playing defense. Step 4 is where we finally play offense. Automate wealth and invest.
Okay, playing offense sounds amazing, but what is the actual finish line? How do we know when we've won?
You can't just save your way to millions. You have to grow your money through long-term, low-risk investments like index funds. And there is an exact calculable finish line for this, born out of the FIRE movement, that stands for Financial Independence Retire Early. The foundational rule of FIRE is that you need to accumulate an investment portfolio equal to 25 times your annual expenses. Once you hit that magic number, you can theoretically withdraw 4% a year, adjusted for inflation, and practically never run out of money.
And this breakdown brilliantly illustrates just how personal that number really is. The numbers shift perfectly based on your own habits. If you are extremely frugal and you can happily live on $30,000 a year, you're aiming for what we call lean fire. You only need about $750,000 to be completely free. If you want a standard median lifestyle spending, say $60,000 a year, you need regular fire, which comes out to $1.5 million. And if you want luxury spending over $100,000 a year, you're looking at fat fire, requiring $2.5 million or more. Financial independence isn't just some vague pie-in-the-sky dream. It is a highly personalized mathematical target based entirely on your lifestyle choices. Now, before we move to the fifth and absolute most critical step of this explainer, the step that protects literally everything you've built so far, I want you to do something right now that costs $0 but pays massive dividends. Subscribe to the Rich Tribe channel, like, comment, and share. Drop a comment with your biggest takeaway so far, and send this to a friend who desperately needs to hear it. Building a wealthy community starts right here with us. All right, let's build your ultimate fortress with Step 5. Protect against future shocks. Accumulating the wealth is only half the battle. Wait, so if hitting your FIRE number is only the first half of the journey, what kind of shock could realistically wipe out something like $1.5 million at that point in your life?
This massive number right here, $713,257. That is the projected out-of-pocket retirement healthcare cost for a 65-year-old couple living with chronic conditions like diabetes or high cholesterol. And yes, that's even with Medicare. Healthcare inflation rises at roughly twice the rate of regular inflation. If you don't build these major medical costs into your FIRE number, your entire life's portfolio could be completely decimated by a few hospital visits and prescription drugs.
But hold on, because here is the most surprising actuarial fact from the data. You might be sitting there thinking, well, I eat clean, I run marathons, my costs are going to be super low. Actually, a perfectly healthy 65-year-old couple with zero chronic conditions is projected to spend over $1 million, $1,084,579 to be exact, out of pocket on healthcare. Why? Because perfectly healthy people live much longer. You have way more years of paying those premiums and more years of compounding healthcare inflation. Planning for medical costs is entirely non-negotiable. And there is one more massive shock you've got to protect against: sequence of returns risk. Imagine you finally retire, pop the champagne, start withdrawing your 4%, and the very next month, the stock market just crashes by 20%. Because your portfolio dropped in value, you are now forced to sell off a much larger percentage of your shares just to survive that year. If the market is down in the first few years of your retirement, it can permanently cripple your portfolio's ability to ever recover. The wealthy protect against this by keeping a larger cash buffer or being flexible enough to adjust their spending down during those market crashes. So the absolutely crucial point is this: hope is not a financial strategy. Mathematics is. We've shown you exactly how to audit your budget, build an unbreakable buffer, destroy that debt, calculate your investments, and protect against massive late-life shocks. Now it is your turn. I'm challenging you right now. Grab a calculator today. Figure out what your exact personal financial freedom number is. And more importantly, what is the very first step you're going to take today to get there? Let's get to work.